For 2 weeks the market priced the off-ramp. The Strait of Hormuz reopened, the war premium drained out of oil, crude eased back near $77. And then, on Saturday, Iran slammed the choke point shut again, declaring the strait closed to all vessels, citing alleged ceasefire violations. The premium that was draining is now at risk of snapping back. Here's why that matters. About a fifth of the world's seaborne oil transits the Strait of Hormuz, so a reclosure is an oiland inflation shock, and it is landing on a Federal Reserve that just deleted its rate cut and penciled in a hike. An oil shock onto an easing Fed is a growth scare. An oil shock onto a hiking Fed is a stagflation scare. That is the vice. So where's the edge? Not in trading the choke point, in owning the supply that profits from the scare without standing in it. The domestic barrel that re-rates on the shock but never ships through the strait and funds its own growth. The crowd trades the choke point. The discipline owns the supply. This is the asymmetric. This is the asymmetric, issue 22, the vice, tech and crypto investing for thoughtful retail from an operator's lens. Issue 14 was the strait reopening, the disinflationary off-ramp. This issue is where that off-ramp slammed shut and the war premium snaps back onto a Federal Reserve that has no room left to cushion it. Here's the one-line read. The disinflationary off-ramp reversed. Iran reclosed the Strait of Hormuz over alleged ceasefire violations, and the formal United States and Iran signing was postponed in Switzerland, so the war premium that had been draining out of oil now threatens to snap back onto a Fed that already deleted its cut. United States equities have not traded since Thursday. Friday was Juneteenth, so the only live tape is the one pricing the vice: oil, the dollar, gold, and crypto. The asymmetric answer is to own the supply, not the choke point. You'll see the same labels throughout: confidence, high, medium, or low, consensus versus variant, what the market believes and where we may differ, and on every call, what would change our mind. That's the discipline. Part 1, the macro regime, the off-ramp reversed, and the Federal Reserve can't cushion it. The 30-second frame. 1. The choke point reclosed. Iran's Revolutionary Guard declared the Strait of Hormuz closed to all vessels on June 20th. 2. The truce is hanging by a thread, not dead. The formal signing was postponed in Switzerland, but delegations are expected back. 3. Oil's reaction is still pending. The last prints had crude near $77 with the premium draining, so the re-rating waits for Monday's open. 4. The Federal Reserve jaw is locked, a hawkish hold, a dot plot that deleted the cut and penciled a hike, and a one-year high dollar near 100.8. And 5. The non-yielders took it, gold eased to about $4,150, Bitcoin near $62,500, Ether near $1,690. Equities are closed for the weekend. The vice is the only tape trading. Start with the choke point. The off-ramp reversed. Iran's Revolutionary Guard declared the Strait of Hormuz closed to all vessels, citing alleged ceasefire and memorandum violations after Israeli strikes on southern Lebanon, reversing the prior week's partial reopening. Roughly a fifth of the world's seaborne oil transits the strait, which is why even the threat of a sustained closure reprices crude. The honest caveat: the declaration is confirmed, but Hormuz has been an on-again, off-again saga, and physical enforcement and durability are not. We present this as a reintroduced risk, not a confirmed multi-week outage. But here's why it matters more now than in February. In the first scare, the Federal Reserve still had an easing bias and could cushion an oil-driven inflation pop. After June 17th, it can't. Now the second jaw, the Federal Reserve. At Chair Warsh's first meeting, the Fed held the policy rate at 3.5 to 3.75%, but the new dot plot removed the 2026 cut and now shows 9 of 18 participants expecting at least one hike by year-end, with 17 of 18 seeing inflation risk tilted to the upside. The dollar held a one-year high near 100.8. Here is the cruelty of the timing. An oil shock that lands on an easing Fed is a growth scare. An oil shock that lands on a hiking Fed is a stagflation scare. The Federal Reserve is not a shock absorber in this regime. It is the second jaw of the vice. Then the assets in the jaws. Gold eased to about $4,150 an ounce, its lowest since June 11th, pressured by the one-year high dollar and higher for longer real yields, We cite gold by level and driver, never a contested period return. The tell is that gold fell while a fresh geopolitical scare was building. The near-term tape is hostage to the rate and the dollar, not the headline. Crypto stayed macro beta, Bitcoin near 62,500, Ether near 1,690, both lower in extreme fear, trading the dollar, not the geopolitics. And oil's reaction is still loaded, not yet fired. The last prints had crude near $77 with the premium draining, so the re-rating waits for Monday's open. A sustained closure is the clean upside risk to oil and inflation. Part 2, in focus, the domestic barrel that doesn't transit the strait. When the risk is a choke point, the instinct is to buy the commodity or the offshore major most exposed to it, but that is buying the choke point risk itself. The asymmetric move is to own the producer that re-rates on the same oil price shock while standing entirely outside the strait. So our live, filings-grounded workup this week is EOG Resources, a large United States producer whose three foundational plays, the Delaware Basin, the Eagle Ford, now the Utica, are entirely domestic and onshore. Its barrels never load onto a tanker bound through Hormuz. In the year ended December 2025, EOG generated $10 billion of operating cash flow on $22.5 billion in revenue, with about $5 billion in net income, and it carries net debt of only about $4.5 billion against that $10 billion of annual cash flow. In the first quarter of 2026, revenue rose about 22% and net income about 35%. Now the debate and an honest correction. The bull in the numbers. This is leverage to the oil price without leverage on the balance sheet. A reclosed Hormuz that lifts crude flows straight through to EOG's realized price on barrels it produces at low cost, and it keeps over $10 billion of annual operating cash flow to fund its program, a recently raised dividend, and buybacks, all from internal cash. Not the bond market a hawkish Fed just made more expensive. The bear and the correction we owe you, EOG is not debt-free. It added roughly $4 billion of long-term debt during 2025 to help fund its $5.6 billion Utica acquisition. It remains low leverage, but the fortress, no-debt version of the story is wrong, and we flag it. And more fundamental, the entire thesis rides the oil price, which is double-edged. The same Hormuz headline that could spike crude could also collapse it if the signing is salvaged. The read, a research view, not a call. EOG is the listed embodiment of owning the supply, not the choke point, a domestic, onshore, low-leverage, cash-generative producer that re-rates on a Hormuz oil shock without ever standing in the strait and funds its own program. Franchise quality is high on the operating and balance sheet metrics. The variables are the oil price itself, which is violently two-sided this week, and the honest fact that the company levered up modestly for the Utica. Own the domestic barrel as the cleanest insulated beneficiary of the supply scare, but underwrite that you are underwriting the oil price and that a salvaged truce is the bear case as surely as a sustained closure is the bull. Crypto and the rails. Bitcoin near 62,500, Ether near 1,690, both lower in extreme fear and testing long-term cycle support, a macro liquidity proxy caught in the vice. Under the price, the supply picture is genuinely two-sided. Long-term holders sit at a record share of supply, while spot Bitcoin exchange-traded funds just went through one of their worst outflow streaks. And the structural rails story keeps its hard date. The European Union's marketing crypto assets transitional period ends July 1st. Only about 210 of more than 1,200 firms are fully authorized. Tether's stablecoin is shut out, and Circle's coins are the compliant survivors. A rails reshuffle that runs on a calendar, not the oil headline. And the thematic. The vice sharpens the insulation test. The build keeps borrowing into it. Morgan Stanley sees about $570 billion of artificial intelligence debt issued this year, roughly 4 times last year's pace, as hyperscalers turn to the bond market. The marginal artificial intelligence dollar is a borrowed dollar. Now layer an oil and inflation shock that could force the December hike, and that borrowed dollar gets more expensive again. So own what is insulated on both axes, from the financing squeeze and from the choke point. The domestic barrel that re-rates but doesn't ship through the strait, the self-funding compounder, the toll booth that prints cash, the sold-out memory, the regulated rails the rate helps, and the hard asset at its floor. Part 3. The Vice. The crowd trades the choke point, the discipline owns the supply. What we are watching over the next 10 days. Switzerland, does the United States and Iran signing actually happen? It is the single swing factor. Hormuz, declaration versus physical enforcement. Monday's open after Juneteenth, the Vice's first real vote in oil and equities. The dollar, does the one-year high extend or self-correct? Federal Reserve speakers on whether an oil spike pushes them toward the December hike. Gold, on whether a sustained closure flips it back to safe haven mode. EOG and the oil strip. The European crypto cliff on July 1st. Bitcoin at cycle support, and the pace of artificial intelligence debt issuance. And we keep score in public. EOG enters as the lead insulated barrel name, the domestic producer that re-rates on a Hormuz shock without transiting the strait. The risk is the oil price itself and the modest debt it took on for the Utica, not the operations. Hormuz and oil a live swing factor. Toast, the self-funding compounder. The dollar a regime signal. Coinbase, the bet on the bill rails. The Federal Reserve verdict hawkish. Oracle on financing risk. Nvidia, the self-funding profit center. Micron, Circle, Palantir, the power and fuel names. Gold, constructive, Bitcoin, a liquidity tape. Dated, falsifiable calls, and we grade them. So where does it land? The disinflationary off-ramp reversed, Iran reclosed Hormuz, and the signing was postponed. This time the Federal Reserve can't cushion it. An oil shock onto a hiking Fed is a stagflation scare, with gold, Bitcoin, and risk caught in the jaws. And the asymmetry is owning the supply, not the choke point, and this week it has a name, EOG, the domestic barrel that profits from the scare without standing in it. The crowd trades the choke point. The discipline owns the supply. This is research, not personalized advice. Verify it yourself. We'll see you in the next issue.